It's very pleasant here in the Bahamas, but how can you run a couple of $1 billion worth of investments from a surrounding like this? Don't you have to be on Wall Street?
We did move here because it is so very pleasant. But we now have found that in the 22 years we've lived here, the performance of our mutual funds is better than in the 25 years we were managing them from Radio City in New York.
Well, how do you account for this? I mean, you could work in Radio City and do things differently.
Yes, we tried to, but we go to the same meetings as the other security analysts, and the people who speak are so sensible that we can't help being influenced. It's much easier to be odd when you're 1,000 miles away.
Well, what's the benefit of being an out-of-towner as opposed to being in Wall Street? I worked in Wall Street for a couple of years, and I like. I've got my best friends actually, and I'm on both coasts, and I like seeing them, and I get ideas when I go there. But the best way to think about investments is to be in a room with no one else and just think. And if that doesn't work, nothing else is going to work. And the disadvantage of being in any kind of a market-type environment, and Wall Street would be the extreme, is that you get overstimulated. You think you have to do something every day. I mean, the Canberra family paid $2,000 for this company, and you don't have to do much else if you pick one of those. And the trick then is not to do anything else, even not to sell it in 1919, which the family did later on. So what you're looking for is some way to get one good idea a year, and then write it to its full potential. And that's very hard to do in an environment where people are shouting prices back and forth every 5 minutes and shoving reports under your nose and all that. Because Wall Street makes its money on activity. You make your money on inactivity. I mean, if everybody in this room trades their portfolio around every day with every other person, you're all going to end up broke, and the intermediary is going to end up with all the money. On the other hand, if you all own stock in a group of average businesses and just sit here for the next 50 years, you'll end up with a fair amount of money, and your broker will be broke. So his activity he's like a doctor who gets paid on how often he gets you to change pills. I mean, basically. If he gives you one pill and it cures you the rest of your life, he's got one sale, one transaction, and that's it. But if he can convince you that changing pills every day is the way to great health, it'll be great for him and the prescriptionists, and you'll be out a lot of money, and you won't be any healthier. You'll be a lot worse off financially. So you want to stay away from any environment that stimulates activity, and Wall Street would have the effect of doing that. I used when I went out to Omaha, I'd go back about once every 6 months, and I'd go back with a whole list of things I wanted to check out one way or another, companies I wanted to see, and I would get my money's worth out of those trips. But then I'd go back to Omaha and think about it.
Curious if you could tell us what it was like when you were out raising money for Oaktree in the early days. I would imagine that today some clients are skeptical, but I would imagine that was it a lot different for you back then? And
well, by the time we started Oaktree, it wasn't that hard because we had a reputation. But when when I started raising money for our strategies, 1978 junk bonds, 90% of investment organizations like Google had a concrete rule against any bond investing below A or below investment grade, which is BBB. And of course, Moody said it's an imprudent investment. So that was very, very hard to overcome. But what you have to do is you have to find a few people. You see, you have to find a few people. You have to go say to them, you should do this because nobody else is. Because nobody else is doing it, it's languishing cheap. You make no money doing the things that everybody wants to do. You make money by doing the things that nobody wants to do, who then turn out to have value. And if you say that message to 100 investors in the beginning, maybe 10 jump on board. After it works for a while, then the rest come on, like the screen says. But hopefully not too extreme. But the point is, it was very hard in the beginning. And in certain foreign countries, it was even harder, because in certain foreign countries where the thinking is a little more narrow than American thinking, I always thought that if I go into somebody's office, I say, you should do this because nobody else is, they'd call the man in a white coat to take me away. They don't understand. I think that Americans semi-intuitively understand the value of contrarianism and of being a maverick. But in many countries, they just don't get it. So, it's very challenging, but, if you can, and you can't convince everybody, but if you can explain the merits and tell the story clearly and concisely and persuasively, then you get some clients. And then if you get good results, then you get more clients.
I am CEO of Pershing Square. It's a much easier business to run than a normal company because we've got only 56 employees. And here the key to successful leadership is, one, hiring the right people. I have the benefit of not inheriting anyone because I hired everyone in the company. I interview every receptionist, I interview every secretary, I interview every investment person. And so I get to pick ultimately everyone that I work with, and that helps leadership a lot. Because if you hire, the key behind leadership, if you hire super talented people, you don't need to do that much leadership because they're going to do the right thing. Second thing is setting up the incentives correctly. So in Pershing Square, everyone is incentivized by how the overall firm does, which I think is a good dynamic because it creates teamwork. I follow the same extreme candor approach in evaluating people.
So I think one question our students might like to hear the answer to is, as they approach their pending careers, is what makes you decide to hire someone whose resume you see or who you interview, and what makes you decide not to do that?
So I have an experience of having made some great hires and having made some hires that stayed with us longer than they should have. Let's just put it that way. And it's remarkable that at least in one case, I had somebody working in the firm who it turned out after he left, we found out he was very abusive to some of the administrative staff in the firm in ways that I didn't ever see and they didn't tell me about, and didn't discover until after the fact. And for years we've said we have no openings, but we talk to a lot of people. In the last 2 years, we've actually made 2 hires that we went out looking for, and what we were looking for, we ended up being, in the terms of a headhunter, being described as a 2+2. And these were young people who did not have graduate degrees, had worked for 2 years at an investment bank, and then 2 years in the private equity field, and had no experience at all in the public markets. And we thought we could be very valuable in teaching them about the public markets, and we liked the disciplines that they had learned in both in the investment banking firm and in the private equity firm. They're being able to cover an enormous amount of ground, literature, information in a short period of time and be able to put it to work in spreadsheets or whatever else we want to have. And so our experience with hiring has been different. We've been, I suppose as time goes on, we get better at it than we have been. We're so small, we're 13 people in total, and we manage about $17 billion. And I have friends in the business where the firms manage $8 billion and they have 50 or 60 people doing that. And so we're highly efficient. We're very focused in what we do. We don't believe that we need to own the market or even look like the market. Our goal is to take our clients' capital and preserve it and compound it at a rate which is above average. And that's what we've done for over 30 years. And that's why we've been successful as we've been.
I think it's helpful to work on Wall Street for a few years. Goldman Sachs obviously has a great training program. Many of the investment banks and commercial banks have a very good training program. I think working at a small fund could be a good experience if it's reputable, if they apply similar standards to what we apply. If they're a growth or momentum fund, we would disqualify somebody because they would have learned the wrong things. But if they're looking for value like we are, that would be perfectly valid. Consulting could be good. We have some people with that background. Really good view into industries, into thinking about tearing apart a P&L statement. It depends on what firm and whether that was a relevant experience. So we're not that fussy, but people right out of college often just have no experience that would be relevant, and it's very hard for them to hit the ground running, and we don't have the ability to train people to that extent. We certainly work with our people and train them a lot, but they need to have some facility with what we're trying to do.
We look for three things when we hire people. We look for intelligence, we look for initiative or energy, and we look for integrity. And if they don't have the latter, the first two will kill you. Because if you're going to get somebody without integrity, you want them lazy and dumb. I mean, you don't want them smart and energetic. So it's that third quality, but everything about that quality is your choice. You know, you can't change the way you are wired much, but you can change a lot of what you do with that wiring. And it's the habits that you generate now on those qualities, or those negative qualities. I mean, the person who always, you know, claims credit for things they didn't do, that always cuts corners, that you can't count on. I mean, in the end, those are habit patterns. And the time to form the right habits is when you're your age.
The second commandment, thou shalt not have an investment team. So again, you know, investment management is not a team sport. It's really designed to be an individual pursuit. And an investing team is in many ways an oxymoron. And one of the you know, there are many reasons why it's an oxymoron, but one of the basic reasons is that any two humans are going to have differing circles of competence. And so if I were to have, for example, an analyst on my team, and that analyst was very bright, and he or she came up with some investment ideas, I may reject them simply because I have a different circle of competence. And so, which is really not doing justice to the analyst, if you will. And the second is that we don't need that many stocks in our portfolio, and so in a year we have plenty of time to research many stocks and to find 2, 3, or 4 of them that that kind of fit the bill, if you will. So they shouldn't. And the other thing is the investment analysis process is really the fun part of the job. So you really don't want to be delegating the fun part, because I wouldn't know what you'd be doing then if you weren't kind of analyzing investments. You know, that's the most fun part.
Why did you decide to sell your company out, I think Affiliated Management Group?
I think selling it out is probably a misnomer. I would say we created a partnership with Affiliated Managers Group. It did solve some long-term issues regarding generational ownership, right. And I have 7 children, and one of them works with me, and so it solves some of that. It provides a way for future people who are working in the company to get some ownership and so right. on. But we really are truly a partner with AMG, and we continue to have autonomy. I think most people that are good in this business have to stand on their own 2 feet and need independence, and I think they truly understand that model and why it's important. So my hat's off to them. I think it's been a win-win situation.
So they provide services that enable you to focus on your prime task instead of back office.
Correct. Yeah, there's some of that, and again, I think it's a win-win deal.
Right. So, Chuck, given your long history analyzing investments, how has that led you in decisions about how to operate your own firm?
So that's a good picture, and so good question. we have a partner in the business who is not involved in the investment side, has a master's in accounting, and has run another public company or another private company and sold it. And so we hired him originally to be our chief financial officer, and we subsequently made him chief compliance officer because our business has an enormous amount of regulation from the government, and our ability to be responsive to that, takes a lot of time. And then more recently, in the last couple of years, we've made him actually the chief operating officer of the business. And so, as he said, his job is to take everything off my desk except the investments. And so that's how we dealt with that. Having said that, I still have some involvement in the running of the firm, particularly from a point of view of what our standards and everything else like that are. And we have a slogan around the firm, which is, we want to conduct ourselves in such a way as there are no questions about what we do.
And we did a number of things at our firm that we think helped us be in a position to be successful over time. One was we wanted flexibility from our clients, that the more flexibility you have, the better your ability to maneuver in complicated and volatile and ultimately fairly competitive markets. So if you have a narrow mandate, like the only thing you can buy is investment grade debt, you will for sure own investment grade debt, whether or not it's actually interesting. When the spreads are narrow, you'll own it. When the spreads are wide, you'll own it. When interest rates are low, you'll own it. When interest rates are high, you'll own it. By contrast, if you have a broader mandate that lets you own all kinds of debt, all kinds of equity, perhaps some private assets like real estate, perhaps hold to cash when you can't find anything great to do, you now have more weapons at your disposal to take advantage of conditions in the market.
And I care about everyone I work with as I do family members. And so we look out for each other, and if someone's going through a difficult health issue or personal issue, financial issue, or I have the benefit of having a lot of relationships, and whether it's the medical community or in the business community or in the political community, and so we help our people. And we don't tolerate insincerity. People are encouraged to admit their mistakes immediately before they figure out a solution to the problem. So when I hired my CFO, in the first year of working with him, he would approach me with a mistake he had made after he had figured out how to solve the problem. And I would get angry with him every time. I said, no, I don't want to hear about the mistake after you figured out the solution. I want to hear the mistake now, and then we can work together on solving the problem. So I think if you have an organization where people very quickly admit mistakes, and where you're candid with them, and they're not punished for making a mistake, that is a very good dynamic. And it's worked very well. We have almost no turnover, even in the reception desk at Pershing Square, and that's worked. It's been a good model. And so I don't do that much leadership, other than I guess on the leadership side, I think you have to. You have to set an example in terms of the way you live, in terms of the way you behave, because that affects how other people will watch you. So my other key success factor for being a leader in the 21st century, in the era of everyone having a video camera on their cell phone, is assume that everything you're doing is being videoed and recorded at all times, and that will, and consider that the video ends up as a top video on YouTube, and then adjust your behavior accordingly. So fair.
One of the biggest problems is if you have a culture where you get yelled at, which we don't have, but it happens at other firms. If you bought something and you realize 5 minutes after you bought it that you made a math error, or you didn't think through a serious risk that you found out about, if you raise it to your boss and your boss yells at you, you have a disincentive to raise it. You have more incentive to hide it and hope it works out. And we never want to have that. So one of the messages I give loud and clear to everyone in the firm is, look, don't view it as not your business if someone else is doing something problematic. If we're buying something and you think it's stupid, I want you to find a way to communicate. I don't want you to do it in a humiliating way to the person that had the idea, but you owe it to the firm, and you owe it to yourself, since you have money invested here and your bonus depends on how the firm does, to raise your concern. We heard about a firm that blew up in the last year and a half, and many people in that firm were worried that the firm was doing things that were not going to work out well, and yet nobody felt comfortable raising their voice. They went home and talked to their wife about it or their husband about it, but they didn't actually raise their hand and say, let's sit down and talk about this because we're taking a huge chance. So by having a good culture, I think you also limit the possibility of serious mistakes. Easily the most important thing is to act with high integrity. The watchword of our firm has been, first of all, put the clients first. If you treat the clients first with respect and with 100% of your efforts, you don't gouge them on fees, you don't proliferate products, you don't get, you don't put yourself in a position where you're thinking only about what's good for you. They know that, and I think that in an indirect way, you actually maximize your own good by maximizing your client's good first. It's the real value of an incentive fee-based approach that, you know, we make some money off of management fees, but the lion's share of what we make is off of the performance fee, and that means that we only make a lot of money after the clients have made a lot of money. And there are not a lot of businesses that actually can operate that way. There are a lot of businesses that sell overpriced, shoddy merchandise and make a lot of money regardless of how the client does. We work very hard to put our employees first. We have a great working environment. We try to include everybody in the firm. In the good years, everybody gets a bigger bonus. 30-odd people own stock in the firm. So again, putting other people first. And finally, it's sort of obvious, and you hear about it all the time, but your reputation is the only thing you really have. You come into the earth with it, and all you can do is make it worse. So you really have to work hard not to make it worse and to keep whatever reputation you've earned. Warren Buffett has often talked about the Wall Street Journal test and perhaps even the football field test. The Wall Street Journal test is never do anything that you wouldn't want your mother to read about on the front page of the Wall Street Journal. And the football field test is to play the game inside the lines, that it's easy to cross the line, it's easy to step out of bounds, and you will forever regret that. And you should assume that whatever you're doing could be on the front page of the paper. And it's a great humbler to say, you know, I thought about that, and it would just sound really bad. It may be legal, but it would sound awful if people heard that we were doing that. So we just don't do it. And in 26 and a half years of Baupost, that's never been a wrong approach.
And then finally, as my last comment, I thought you might find it interesting as to what we've tried to do to communicate to our investor base. When we started, one of my partners said, you know, we've got to find a way to make the fund less volatile. And I said, well, I don't want to make it less volatile. How about this? Because he was worried about investors and would investors give us money if our unit price was volatile. I said, how about we try communicating and educating our investors? So on that chart, the market is the lower line. Our unit price performance, so based on market value, is the middle line, the black line. The green line is our portfolio intrinsic value. And so I thought at the very beginning, let's tell people what we think it is, the change in portfolio intrinsic value. So if you read our annual letter, what we tell our investors is, in the long term, the only thing that matters is the unit price. But in the short term, and we argue that it's up to 5 years, you should listen to what we think we've done in terms of the business values of the portfolio. So we publish the annual change in our intrinsic value for the last 5 years. We don't go beyond that because you could be telling people for 10 or 20 years, really the portfolio is great, but if it doesn't show up in the share price over time, then it's going to sound pretty hollow. And honestly, it's been reasonably effective. I mean, investors do want to try to think long term. They just have trouble with doing it. They know they should, and then they can't. And frankly, it's one of the things that we love about the public market. So I'll come back to the office and express frustration with my partners about, well, we met with this investor, and he's complaining about the unit price in the short term. But then we pause and think, that's the great thing about the public market, the psychology that exists, and why company share prices, if they're going down, they just keep going down, often for a very long time. So just thought I'd share with you, that's one of our attempts to get our investors thinking long term. But it is a struggle to have investors do that. I often say to them, we simply own companies. It's not our fault that they're public. So when we were private investors, we knew how they were doing. We looked at the results. We just do the same thing now with public companies. And if they're doing well and the share price is going down, that doesn't bother us. What bothers us is the results are not up to what we are expecting. And so this is just one example of how we try to get our investors thinking about value as opposed to mark-to-market share prices.
We've grown over the years to now 8 additional professionals on the investment team from the 3 founding partners, and then 14 additional employees. And I should point out Michael Bowen is on the call tonight. Michael is our most senior person on the client-facing side, the capital formation side of Turtle Creek, which is for us, an equally important part of the business than as much as the investment team. I mean, of course, you need the economic engine, but for those of you thinking about starting a fund and being a value investor, I'll warn you, funds are not bought, they're sold. You need to have, if you will, quality client-facing people like Michael to handle all of that illogic and inconsistency that every investor has as a client.
What we have found is with our investors is that if we can get them through a full cycle to see how we operate, then usually they'll hang in there with us because they can see what happens through a full cycle. But getting through that first full cycle can be a challenge from time to time.
Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.